I'm Laurie Osgood. I'm the Family and Consumer Science Agent here in Gadsden County. And if you're not familiar with Gadsden County, we are the county that's just to the west of Leon County. Gadsden County is a veteran community to Tallahassee. And then I have my colleague, Lisa Hamilton. Lisa here is the Family Consumer Science Agent in Volusia County. And if you're not familiar with that county, that's Daytona Beach, which we all know and love. Lisa, would you like to say anything?
Welcome, everyone. Thank you so much for being here. We're excited to talk about this topic.
Okay, so you guys know that we are part of the University of Florida IFAS extension. We're in the Institute of Food and Agricultural Sciences, IFAS. We are a federal, state, and county partnership dedicated to developing knowledge in agriculture, human and natural resources, life sciences, and enhancing the quality and sustaining the quality of human life by making information accessible. But basically what that means is we bring the evidence-based information from the university to the communities. So we do all kinds of things here at the Extension Office. We do soil samples, we work with farmers, we work with master gardeners, we do all kinds of stuff. Credit counseling is just one of the things we do. And if you've ever been in one county, if you are in a county and you see this blue University of Florida sign, you know you're at the right place. Oh, and I forgot to mention, we also, 4-H is a big part of our program as well. So what is financial well-being? I know you're here to talk about boosting your credit, but the most important thing about health in general, you know, eating right and take care of yourself, but financial wellness is just as important. So when you are well financially, then that's the first step in boosting your credit. So it's a highly personal state. Everybody has different values and different views of what financial well-being is. It's not fully described by objective financial measures. It's well-being is defined as having financial security and financial freedom of choice now and in the future. So one of the most important things about being financially fit and also boosting your credit is kind of knowing what your money values are. Money values are our beliefs, basically, of how we think about money. A lot of people grow up in an environment where parents never talked about money. We never knew if our parents could afford the utility bills or if they saved or anything like that. It's kind of the beliefs that are instilled in you from whether it's your family or your faith-based institution or even your friends. So that it's values that are ingrained in us. We all have those values and they shape kind of how we spend money. We're going to talk about that in a minute. And so the closer our spending plan matches our values, the easier it is to stick into a spending plan so that we can be more financially fit. So values and budgeting, our values change over time, obviously. Your values in money are probably totally different now that you're a working professional as opposed when you were in high school or even in college. So they can change based on your life experiences, based on some religious beliefs you might have, or what priorities you have. If you have a little kid and you have a college fund set up, so your financial aspects and values kind of change a little bit. And your family spending habits affect how you spend your money, right? So when you're thinking about a spending plan, the first thing you need to do is figure out where your money is going, right? Are you spending money on pizza? Are you spending money on your pets, which is a huge expense? Also, some of the other things, you have credit card bills. Do we have a lot of credit card bills? So think about where your money is actually going when you're thinking about how to get your finances aligned. Tracking your expenses is kind of like the first step in knowing where your money is going. You know, knowing what you're spending your money on, but tracking those expenses, and know that a budget is a really good thing for everybody to have, but just know that it changes over time. It's not a stagnant document. It's not a stagnant thing. You know, what we spend our money on changes as well. If you have an unexpected expense that you weren't counting on, and you might not have an emergency a savings account set up, then your tracking of that expense is going to change a little bit. And it covers where you can make the changes to get back on track. So we know there's lots of ways of tracking your spending. It's real important to use whatever works for you. Some people, this is great if anybody's interested in it. I love this, our money management calendar. It's a document, it's a calendar, but it also is a really good way of tracking your expenses each month. Not only just your fixed expenses, the expenses that occur every single month, but if you have anything flexible or something that's unexpected, it's like your nephew's getting married or your daughter's graduating from college, whatever. It helps you plan for those bigger events that aren't a normal expense for us. But then there's also some really good apps that are out there, so you can do it manually on a money management calendar like I talked about. You can do it digitally with an app, but then a lot of your bank accounts have apps as well. And this one we really like here, and there's a link if anybody wants it, to NerdWallet. NerdWallet is an app, but they're really growing. They've done a lot of really good things lately. There's a lot of really good resources in NerdWallet, so check it out.
I'm putting that link, Laurie, into the chat for everybody.
Okay.
Managed to get my computer
to make sure. Well, one thing I want to say is to go back to that. Lisa, can you explain this one a little bit more succinctly about the second?
Yeah. One thing that we want to caution everybody about, we are real advocates of tracking your finances, because if you're trying to build your credit, you need to be using your money as effectively as possible. And so having apps or manually tracking how you're spending your money, it's really critical to manage it well. So we think that the apps are really great, all the software programs out there, but be cautioned, because when you give authorization for a third-party entity to connect to your bank account, if there's a breach, if money is stolen from your bank account from that source, you're not going to be covered by the FDIC insurance, because you have authorized that third party to connect to your bank account. And so, of course, Mint, YNAB, EveryDollar, all of those apps have extremely good security. We just recommend that you're using a nationally known, a really well-known app, and don't open your bank account, to a software that you're not sure is very secure. And in the chat, I put the link to this article. I just really like this NerdWallet article about all the different apps that are out there and the pros and cons.
Yeah. Thanks. And one more sort of unrelated, kind of related tidbit is a lot of us use cash apps to pay, whether it's your babysitter or your lawn guy or whatever, like Venmo and some of the other ones. Make sure when you are using one of those apps to mark your account as private, because if you don't, then anybody you give money to or use Venmo or whatever, as an example, as a payment system, they can see all your information if it's not private. So make sure you go in under your account settings and mark it as private. I think a lot of people learn that the wrong way or the hard way. Okay, thanks, Lisa. So go ahead, Lisa, take it away.
So we're talking a lot about basic financial practices here in preparation for strategies to boost your credit. But this really, basic good financial management is a strategy for boosting your credit. You need to have control of your money and your spending. This is a tool that a lot of financial advisors use. It's the 50-30-20 budget rule. 50% of your income needs to be spent or should be allocated for your needs: clothing, housing, transportation, utilities, insurances, that kind of stuff. The idea is that 20% of your income would be for savings and debt repayment. And so that's going to be, the debt repayment is it's going to be personal loans, credit cards, that kind of debt. Your auto and other kinds of debt, if you had a house, would be in that 50%. And then 30% is going to be allocated to your wants: vacations, gifts, fancy shoes and clothes and those things that we like to buy. We use this as a tool. However, in the world that we live in today, where expenses are outpacing income, I don't like to preach this as a definite thing. What we want you to look at it as is a tool for looking at your spending and saying, what percentages am I spending on things, so that you can move toward that financial well-being by knowing what's going out and what's coming in. Laurie? Okay, so in order to boost your credit, you need to understand how credit works. So we're going to talk for a few screens, we're going to talk about the basics of credit. Next.
All right, I'm letting somebody in the room. Yeah.
All right, key takeaway here, folks. Your credit history affects your access to credit, loans, jobs, housing, insurance, and really everything now. Your credit is pulled either a hard pull or a soft pull to assess the kind of risk that you are by all kinds of companies. And so it's really important. Next screen, Laurie. But even more important, the takeaway from this class is that your credit history does not have to be your credit future. So if you are in a credit bind, if something bad happens, your life is not tanked forever. All credit can be fixed. It's a matter of time and perseverance and maybe some money. Next, Laurie. So let's start with some basics. What is good credit? You see that the credit scale runs from 300 to 850, and good starts at 670. Right. So what I want to say here is you see that these are categories. They're zones, right? It's 670 to 739 is good. 740 to 799 is very good. So when you're looking at your credit score, do not obsess over the number, right? You want to get in the range because there are many different versions of your credit scores. There's like 50 plus different versions of FICO scores. Your FICO score that's used to buy a car is different than the one that you use to buy a house. And so we really preach that get in the zone, the best zone that you can. Next, Laurie. Also, when in our work, we find that a lot of people are really conservative about the use of credit, right? And as Laurie mentioned about being taught credit or financial behaviors by your family, or having developed your own values, you may not feel comfortable using it. And so we work with a lot of people who have no credit or very limited credit. And that can limit your options for using credit, for the things that you need in your life. So if you are one of those people that has a thin credit file, that's what the lenders call it, then you may, as a part of the strategy for boosting your credit, you may need to add some credit, and you just want to do it strategically, and we'll talk about that. Next screen.
Okay, so let's talk about the cost of credit. As you guys can imagine, it can be pretty expensive. So let's just take this example. If you have a $2,000 credit balance and your interest rate is at 19.8%, which is a range, just like Lisa was saying, that's probably one of the lower ends. I've seen credit interest rates up to 25, 30%. But if you just pay your minimum monthly payment, which for a $2,000 credit balance, let's just say it's $35. It will take you, if you don't pay any additional amounts, but accept that minimum payment, it'll take you 14 years and 6 months to pay off that $2,000 debt. And it's going to cost you about a total of $4,100 for that $2,000 debt. So you can see that the cost of credit, but also the problem with paying just the minimum monthly amounts. If you can pay a little bit more, this number and the amount of time it'll take to be paid off will dramatically decrease. Let's look at another one. Okay, so let's talk about, say you're wanting to buy a car. It's a $25,000 car. You're going to finance it for 4 years, which is pretty standard. If you had low credit, which is, and that according to that range Lisa just showed us, 500 to 580, you're going to have an interest rate of about almost 15%. Your monthly payments are going to be $693 a month, give or take. If you had a higher credit score, 720 to 850, which is high, Your APR, which is your annual percentage rate, is 3.3%, give or take, and that's going to reduce your monthly payment to $557. So that ends up saving you about $136 a month based on that credit score, but that also saves you about a total of $6,500 over the 4-year loan. Think of what we could all do with $6,500, right? Okay, Lisa.
All righty, I'm going to move quickly through the next few screens because we want to talk. We just want to make sure that everybody's on the same page with the basics of credit scoring and credit information. What is your credit score? Your credit score is a number that's calculated by algorithms that are owned by the credit bureaus, TransUnion, Equifax, and Experian, right? And there are others. There are other types of algorithms that are calculated, or other people that calculate credit scores. Generally, the higher the number, the better your score is. And it really is a number that predicts the likelihood that you will pay your bills on time and that you'll pay your credit obligations in full as agreed. Next. A couple of other things to know about scores. So most of us have heard of FICO scores, and I said there are about 50 plus, maybe even more versions of the FICO calculated in any number of ways. And it depends on what the vendor or the lender wants to know and see about you. They can pull the score differently. The FICO score that you see is probably not going to be the one that the creditor sees. And so this is why, again, I say, don't obsess over the number. You want to get in that range. Now, a Vantage score is a relatively new way of calculating a score. If you're using Credit Sesame or Credit Karma, then those softwares use the Vantage score, whereas most of your banks and your lenders use FICO. And so you want to make sure which score people want and which score that you're looking at. Next screen. All right, now here's where we're really going to dig into it, you guys. There are 5 factors that determine your credit score every month. And understanding this pie is really where you understand how to boost your score. Every strategy for boosting your score comes out of how the score is calculated, right? So 35% of the points come from your payment history. The most important thing you can do is pay your bills on time. The next most important amount or most important factor is your utilization, or the amount that you owe. Utilization is going to be that percentage of available credit that you're using. And the algorithms are going to give you more points the closer you are to 30% of utilization of all of your credit available. So when you're trying to figure out how to boost your credit, you really want to understand your utilization, and you want to reduce it as much as possible. And you want to pay the bill before the due date and pay as much of it as you can. And that's when you're going to see your score boost. I could talk so much more all day about all kinds of things related to utilization. And that's where we're going to point you to additional credit counseling from us or another trusted source to help you understand. The next important thing is 15% of your credit score is based on the length of your credit history. This is also incredibly important and more complex than you realize in how it affects your score. Don't close credit lines if you don't have to. And then finally, we've got the credit mix that refers to secured and unsecured credit. Unsecured would be a credit card. Secured would be a car loan, right? So lenders like to see a mix of credit, and you get rewarded with points for having that mix of credit. And then finally, new credit, is 10%. But if you're applying for multiple new credit cards, within a 6-month window, within a short period of time, it's actually going to hurt you. You're actually rewarded for not applying for new credit too often. Next screen, Laurie. All right. So we talked about, the credit scores. We're going to talk about credit reports and how these two things work together to help you increase your credit scores. Key takeaway: get and review your credit report at least every 12 months. But right now, because of the CARES Act and all of the economic things that have happened to us, you can pull your credit reports weekly through the end of 2023. Next score, Laurie. And how do you do that, you ask? Well, this is how you do it. We recommend using annualcreditreport.com. It's a government-backed website. You can get a copy of all 3 of your credit reports there. You also have the ability to dispute and do other work and communicate directly with the credit bureaus. That's what you want to do when you're working on your credit, as much as possible, is work directly with the credit bureaus. Next, Laurie. I'm making sure I'm where I need to be. Lisa, where can I get my credit scores? This is, it used to be much more difficult to get your credit score, but now it's pretty easy. You can, usually it's on your credit card statement or on your bank account. You usually can see one there. Those are usually FICO scores, be aware. The credit bureaus, when you go into annualcreditreport.com, or if you go to a credit bureau website, you can get a score. You're going to pay for it if you get it directly from them. Nothing wrong with that. They have monthly subscriptions. You know, if you're really actively working on that score, if you're trying to buy a house, or, you know, if you're really needing to do a lot of credit work, there's nothing wrong with buying that subscription for a few months to use it. You can also get your FICO at myfico.com. You can get a Vantage score at vantagescore.com. And then I wonder how many of us are using Credit Karma or Credit Sesame. I really like both of these softwares. They're great tools for looking at your credit score. It's easier. Their websites are much easier to deal with than the annualcreditreport.com. But remember, Credit Karma and Credit Sesame are using the Vantage score. You're not seeing a FICO. And remember, they are a third-party entity. You are authorizing them to access your credit accounts from Experian, TransUnion, and Equifax. And so they're not getting it in real time. You don't know when Credit Karma pulls that credit report from the bureau. So it's a great tool. I've never seen them have a credit breach. I use them, I like them. But remember, it's not the same as the credit bureau. And I saw a question come up, and we'll get you at the end. Laurie?
Sure. One other thing I'd like to add is, even though the annualcreditreport.com is free, be really careful not to Google freecreditreport.com, because you know what they do when you Google something. The ones, I don't know what the logarithm is, but freecreditreport.com comes to the top, and it's really easy to click on the wrong one. If you click on the freecreditreport.com, you're going to be hounded by people trying to get you to buy their products, and you're going to get phone calls and all. So make sure you're going to annualcreditreport.com. They don't do that. Okay. And that's the one that's free. That's the one we advocate for. But a lot of people have never even looked at your credit report before. You know, we talk about credit reports, you hear about credit reports all the time, but have you actually looked at yours? So when you're looking at your credit report, you're going to see there's going to be several parts. The first thing is going to be your personal or identifying information, public records, et cetera here. But one thing that's real important, and we're going to talk about it a little bit, Janet Wood, I'm going to pick on you. A lot of times sometimes what happens is there may be another Janet Wood in the state of Florida. Chances are there's more than one of you, right? Because it's a beautiful name, but it's not a really strange, different name, right? So you have to make sure that everything that's on that credit report actually belongs to you, and that another Janet Wood who may not have the same, or may have some credit issue doesn't appear on your credit report. So it's real important to go in there and look and see if everything belongs to you. And like I said, we're going to talk about that in a minute, but it's really important for you to make sure that everything there belongs to you. And then the inquiries are really important too, because every time you're asking someone to pull your credit, it's going to show up. So if you go and you're looking for a car, and you go once, and we're going to talk about this a little bit more too. If you go once a month to look at a car, they're going to pull your credit report. It's going to show that many times, right? So Lisa, you could talk about that in a minute. But when you're getting to the point where you want to buy a house, Lisa, go ahead and tell them what I'm saying so I can say it. You can say it more succinctly.
I mean, if well, we're going to talk about the importance of getting ready to shop.
Yeah.
And having your credit pulled, but we've got a screen on that, Laurie. So
Okay, good. Yeah, that's what I thought. Okay, good.
Yeah.
Okay, so let me ask you a question then. When you request your credit report, does it reduce your credit score? So you go to annualcreditreport.com and you request your credit report. Is it going to give a ding to your credit score? You guys can unmute yourself or you could put it in chat, but I'd like to see what everybody thinks. Anybody brave enough? Janet, that I called you out already once. Anybody want to give us their ideas? I'll look in chat.
Yeah.
Ooh. Lots of no's. Very good.
Good.
Absolutely. You're right. So no, it does not affect your credit score. Okay. Okay, Lisa, go ahead.
So finally, we're at the topic. What are strategies to improve my credit score? Donna, I see your question and we'll get you at the end. Thank you. So really, I'm fond of saying that fixing your credit is as easy as 1, 2, 3. You're going to get those credit reports and scores. You see what's going on. And then you develop a strategy to increase the positives, right? Maximize everything that you can to get that score moving up, and then resolve any negatives so that you're not continuing to drag it down when the algorithms calculate the score every month. Next, Laurie. And I'll reiterate this one more time. Your credit score, your credit history is not your credit future. So again, when you start digging into it, if you find a problem, there's always ways to resolve it, and always help is available. Next, Laurie. You remember our friend, the credit pie, right? So what we do is when we're working with someone on boosting their credit, we're going to look at your credit report and we're going to analyze it based on the different factors for improving the score. And we're going to figure out how to make your payments on time. If you need to do auto payments, great. If you're somebody that's afraid of doing automatic payments, because a lot of people are, then let's set up some calendar reminders. You know, there are always ways to help you build your financial skills so that you can learn how the system works and make it work for you, right? That's what we're all about. So making those payments on time is your #1 priority. If you can't make the payment or the full payment, then you need to communicate with the creditor and ask them, you know, I'm in a bind, I've got a problem. What can I do to make sure I'm protecting my credit score? Because they understand, and all of the companies have options to work with you. The next area, and maybe this is one of the best areas to get that strategy to boost your score, is looking at your utilization, right? Ideally, you want to pay down debt and you want to not use your credit cards, right? Not have too much debt. But that may not be the case. You may be in a bind. You may be in school. You may have expenses that you could not avoid, like refrigerator died, there was a flood, your water heater. I mean, all kinds of things happen to us. And this is why we need credit, right? And this is how we beneficially use credit to maintain our lives. When that happens, you need to immediately start making the plan for how am I going to pay it off? Or if you find yourself with a lot of debt, then you want to be aggressive with contacting those creditors and saying, can you give me a rate reduction? You want to look at, is there, do I have room on another line of credit that I could move something to that's going to cost me less? When I'm working with someone, I really look at, what is this credit costing you? We have a wonderful software called PowerPay that we use with folks to figure out how to pay off debt the fastest. But, in terms of getting that quick boost to your credit report, this is the main thing. Paying off debt. If you get it down to 30% or below 30%, then you get points. If you actually get down to 10%, if you're carrying debt and you pay it down to 10%, you'll also see a really big spike in a score quickly. So this is the best area. This is also an area that can help you if you have low credit. Then if you open another line of credit so that your available credit is higher, that means that the percentage of use is going to go down if you have more credit limit. And so you can use that technique judiciously, carefully, strategically, right, to boost the score if that's what you're trying to do. But you don't want to spend the money. You just want to use it to increase your limit, increase your availability and reduce that utilization. Okay, then, so open new credit carefully, but it can be good to open new credit to boost the score. Initially, the score will go down, and then when you make a payment on that, any kind of new credit, then you'll see it come up quickly. Keep old accounts open, even to the point of, think about this, if you're about to pay off a car, that's going to close that account. That you're actually going to lose credit history when that account closes. So sometimes when you pay off a loan, your score goes down because you lost that age of credit indicator, you know, on your score calculation. And so if you're getting ready to buy a house, you got to decide, well, should I pay this off so I've got more debt in my debt to income ratio calculation? Or, you know, well, how is that going to affect my score in terms of my age of credit? So this is something we would do in a counseling appointment. And then finally, do need a mix of credit. So if we're doing credit counseling, we're going to look at that. And then we're going to make sure you're really limiting your credit inquiries. And like we said, we're going to talk more about that in a minute. One other thing in next screen, Laurie, is you may want to consider the alternative credit history. A lot of us are paying rent and we're not getting the credit for that. Rent, utilities, all kinds of things that you see here on this list. And now there are a lot of new apps, a lot of new softwares out there where you can pay someone to actually help you report those good on-time payments to the credit bureaus. But it's a real mixed bag, because right now I don't see any of them that actually report to all three. You're going to pay a fee. They may only report to one. They may only report to two. They may be limited in what kinds of payments they can report. And so I don't have a referral I can give you right now. I'm just going to say that if you're doing this and it's working for you, awesome. I don't think it's a bad thing at all. But you just want to do it and make sure that, that it is benefiting you. A lot of landlords now are offering that. You can pay them and they will report on your behalf. That doesn't seem like a bad thing to me either, if it's worth it, you know, if you're trying to boost the score. We can talk about that more. Go ahead, Laurie. I lost track of where I am, Laurie. Is this me?
Yeah.
Okay. All right. Thanks. Thanks. So, all right. So this is easy peasy stuff that you guys know. How do you build your credit? Well, you use it. You get credit, you use it, you pay it on time, and you use it wisely, right? So a secured credit card is a great way to start. Credit builder loans are out there. There's some discussion in credit world that it's better actually to get a loan with installment payments than it is to get a credit card. There's different ways that, you know, that the algorithms work with the different kinds of credit, you know, that affect the score. If you're just starting out, becoming an authorized user on someone's account does help a little. It's not going to be as, you're not going to get as many points as if it was your credit, but you will get some. Having a co-signer on a loan is good. Just remember that if you default on that note, then the other person has to pay for it. And if you're late, it tanks their credit too. So, you know, really, you know, be respectful if you're getting a co-signer. And then sometimes, you know, we don't love the credit cards at stores and gas stations, but, you know, if you're really starting out, they're easier to get. And so getting one or maybe two is a good way to get started building credit and boosting the score. Go ahead, Laurie. All right, here's the last thing I think in this section. Rate shop strategically. So if you're buying a car, if you're buying a house, if you're needing a personal loan, especially any of the big ticket items that you might be shopping for, the law says that if you shop and have your credit pulled multiple times in like 30 to 45 day period, then it's only going to count as one pull, right? And that's great because of course, as consumers, we should be able to shop for rates, right? We should be able to shop for the best deal. But I have here, you notice 14, 30, or 45 days. And that's because it varies according to the credit bureau as to when it only counts as one pull. And if you're shopping for a house, it's 30 to 45 days. With a car, 14 and 30. So really what we advocate is get ready, get ready, get ready. Save money, get the credit score where you need it to be, and then shop for the car. Boom, boom, boom. And then shop for the house, right? Bam, bam, bam. Get it, get ready, and then get it done. Next screen, Laurie.
Okay, so this is just getting back to those, your values and also boosting your credit. It's important to not only take those pointers that Lisa gave us, but also maintain them by paying your bills on time, making sure you're making at least the minimum payments like I talked about. Continue to pay down your debt, like Lisa advocated for the PowerPay. If you go in, I believe it's just powerpay.com that you Google. It's a wonderful website that really helps you understand the importance of paying down debt and how it can really help you. But use as little credit as possible compared to those credit limits, like Lisa was saying, 30%. Hopefully that could be the maximum. If you get it below that, it's even better. Don't apply for too much credit, especially if you're in the process of buying a home. Say you've gone through everything and you've gotten pre-approval. Don't be tempted to go out and get a loan to buy furniture for your new house because it throws everything off. Check your credit reports regularly. Like I said, Janet, I'm going to pick on you again. Make sure everything on your credit report belongs to you. Keep good records. We've had some emergency disaster situations here in the state of Florida. So make sure you're keeping your reports in a safe place and your documents in a safe place. Receipts, especially if you're buying something like Lisa was saying, if your hot water heater goes out and you have to buy a new one, there tends to be a warranty for a couple of years on an item like that. Make sure you're keeping those items in a place that you can easily access, but it's also safe. But just know that although it doesn't take a whole lot of time to ruin our credit if we're not paying our bills and we're not making sure we're paying at least the minimum, it does take some time to improve your credit. So give yourself some time if you're looking to buy a house or you're looking to buy a car or you're just wanting to improve your credit score. Just know it takes a little bit of time. It's real important, we're going to talk about this in a second, to resolve those negatives on your credit report. So we're going to talk about how to do that. So if you find errors in your credit report, file a dispute right away. Don't ignore those letters that you get. It's a human nature to ignore that kind of stuff. Don't. Keep on top of those disputes and keep good records like I talked about. Okay, Lisa.
Alrighty, so we're at 12:48, so I'm going to move quickly through.
Okay.
Because, remember I said, fixing your credit is as easy as 1, 2, 3. Get your information, maximize the positives, resolve the negatives. So there's a lot of rules and there are methods, right, for resolving collections and negatives. And so we're gonna do an overview of that, you guys, and because there's a lot, you can really get in the weeds in talking about it. So we're happy to stick around at the end or get with you individually if we need to talk about more. All right, so, go back one, Laurie, sorry. The main thing to remember with collections or any kind of negative that comes at you is that our protections as consumers are, the first 30 days are so important. If in those first 30 days, if you get a collection or if somebody calls you, or if you see it on your credit report and even if you didn't get a letter, because that happens a lot, then you need to contact the creditor, the debt collector, or the credit bureau within those 30 days and request a validation of that debt, because we do have the protection as consumers if the debt collector is, cannot show that they have the information where you agreed to pay this debt, then they have to remove it from your credit report and they cannot put it back. But like Laurie said, you've got to be on top of it and you've got to keep the records. So within those first 30 days, we have the most protections for disputing and getting things removed from the credit report. After that, you can still do it, but it's not quite as easy because the debt collectors aren't under the same requirements. Go ahead, Laurie. How do you do it? You can do it online. You can do it by mail. Next, Laurie. There's specific information about what you want to include in validation letters or in letters where you're asking for something to be removed. There's a lot of templates out there on the internet. This is what we're told, that if you're using a template, then, you know, the credit bureaus have readers, right? They have AI reading the letters and things coming in. If you really have something that needs attention, you're better off to hand write a letter and send that in, certified return receipt. So you have proof of when they received it and you know when that timeline is running, right? Because you've got 30 days to send it in, they've got 30 days to respond to you. So consider if you've got a problem, you can use the credit bureau. I like using the credit bureaus to dispute and request validation rather than going into with a debt collector. I think going right through the credit bureau is the best way to go, especially online. There's records right there. The records that you need are going to be right there that you can access. But if you do have to go through the debt collector, put things in writing, make sure that you're doing that certified return receipt stuff. Next, Laurie. And make sure that you're sending copies of backup, not originals. You really have to, if you're making your case, if there's a collection and something is wrong, you have to prove it. And the more backup you have, the better. And you want to just keep a copy of anything that you send to people. That's pretty obvious, but it's worth saying. Next, Laurie. And then remember, even if you did everything you were supposed to do and you sent it in and you communicated, you've got to check to make sure that what was supposed to be done was actually completed, because it doesn't always happen. And, you know, it's an unfortunate situation to me in the sense that, you know, we don't have control over what's going into those credit bureaus in some ways, and we're at a disadvantage as consumers because we don't necessarily get education early on about how to do this. And most often, as Laurie said earlier, most often we learn how to fix things and how to take care of it when there's been a problem and we're doing a cleanup. So keep on top of it. Last couple of things here in the resolving negatives. There's really good news out in consumer land that there's new law that is protecting us. Now, medical debt is not going to be shown on your credit report until it's 1 year overdue, giving you time to resolve things with medical providers and through insurance. And then also medical debts of less than $500 are not going to appear on your credit report. One note, if you're buying a house, a lot of lenders don't consider medical collections. If there are medical collections on your credit report, a lot of lenders, mortgage lenders, don't actually factor that in, or they'll only factor it in if it's over $2,000 or a certain amount of money. And so this happens with a lot of people get medical collections on their credit reports, and it's not going to hurt us as much as it used to. Next, Laurie. And
yeah, so it's real important to know that there are a lot of scams out there as well. You guys have all seen those signs on the side of the road that says, well, that they'll repair your credit or whatever. Just know that anything a credit repair company can do for you, you can do for yourself. They're going to do the exact same things that Lisa and I have been talking about. So just look at your credit report, be aware what's there, but also be wary of any kind of credit repair companies or programs, because yeah, do it yourself. Okay, so I want to ask you a question. which one of these actions do you think will boost your credit? Okay, so I'm going to count it 1, 2, and 3, right? So put it in chat or just unmute yourself. So which one of these actions will boost your credit? Paying off a collection on your credit report, opening a secured credit card, or paying down a credit card balance? Which one do you think? That's a trick question. Anybody? Yeah, very good. Oh, absolutely. Thank you, guys. Absolutely. All three of these are really good ways. It was tricky. Sorry.
But,
It's lunch and I'm tricking you guys. Go ahead.
Kind of a good question, because if you pay off a collection on your credit report, depending on how old it is and what it is, it can actually take your score down. And the same thing with opening a secured credit card. Remember, it's going to go down first, and then when you use it and pay the bill, then your score is going to go up. So really, the one thing that absolutely guarantees a boost in your score is paying down a credit card balance. Others, it's really a complicated scenario.
It's complicated. Great.
Thanks, Laurie.
Okay, go ahead, Lisa.
One last thing, we're kind of bringing it back to the idea of financial well-being. We do this because we like to help people. And as Laurie said, we've worked with thousands of people now, and we see there's a lot of stress and trauma and, a lot of struggles around money. And so this is a no judgment space, and we're happy to help you. What we want to do is help you from where you are, just get moving to where you want to be. And one way to do that is, next, Laurie. Is that me?
Yeah.
No. I'm a big advocate of having someone in your life that you talk to about money. What we know is people are told, don't talk about money. Don't tell anybody how much money you make. Don't tell anybody how much debt you have. I mean, those are really strong messages that we've had since childhood. And that doesn't help you. It doesn't help you build financial well-being or, manage your money. And so a money buddy is a person that you can really talk to about money problems, resolving money problems, insurance, all kinds of things. But it's got to be there's got to be an official agreement. It's a real relationship where you're going to help each other be accountable. For example, my brother and I are now each other's money buddies, and he'll tell me something, I'll tell him something, but we circle back. Hey, what happened to that? Were you able to resolve that dental bill? Did the insurance company take care of it? So your money buddy is a person who's going to ask you and follow up and support you in actually getting things done.
Yeah, because that lack of communication about money issues are one of the biggest one of the biggest problems in a relationship, whether it's a marriage or whatever. So it's real important to start a relationship, not only have a relationship, but to start a relationship being completely honest about money and being able to talk about money, because like Lisa said, and I said earlier, it's just not how a lot of us were raised. Okay, so we wanted to talk to you guys about a couple other opportunities we have. Not everybody is at the point where they are ready to buy a home. So we know that a lot of us are renting. And so we're offering these classes you see through the end of the year called Rental Realities, Rights and Responsibilities, because just like we've talked about all these things that we talked about today, boosting your credit and buying a home, there's a lot of nuances with rental as well. What your rights are, what you should expect from your landlord, but also roommates and everything else. So this class is a really good one if you guys are interested in. It's a free class as well. That QR code down there works if you guys want to just put your phone up to it and register. But it's a really good class to know about the rental situation. So I'll plug. The other one we want to plug is financial counseling, because everybody has a different situation. And in a class like this, it's not really conducive for us to talk. So we offer financial counseling. You can see this link here. And if you don't mind putting that in the chat, Lisa, you can sign up for free credit counseling through one of us who are in the extension money management, family resource management program. So take advantage of that. There's a lot of really smart people that can help you with whatever financial situation you're in. Okay. So right before we go, I just want to ask you guys to put in chat just something that you've learned today, something different that you didn't know, something that you may have you thought differently about, or something that you've learned. I won't make you, you don't have to necessarily say it out loud, but if you can put something in chat, I'd appreciate it. Just one thing you learned. Or somebody said the 50, 30, 20. Yeah, that's really interesting. The difference between Vantage and FICO. Yeah, absolutely. The pie chart. Oh, we love that pie chart. It's a really good visual. It's a good thing to remember. Closing credit lines. Don't close credit lines. Yes. Keeping old accounts. Exactly. That's not something you would expect to work for you, right? To boost your credit, giving you steps. Absolutely. Those websites and apps, there's so many out there. So just like Lisa said, go in there and find the one that works the best for you. Just be careful, just like everything else. I'm gonna give you guys just another couple, like another minute to put anything in that you can think about. Lisa put in the link to the credit counseling. We recommend you take advantage of it because it's great. There's also the link to the rental realities class. It's shorter than this one, but it's a really good one if you're, and even if you have kids that are renting, that are, going to college or whatever. Kids are just like everything else. We don't teach kids how to be careful with their money and how to be careful about renting. And nowadays, you have to, there's a lot more going into renting apartments than used to be. Okay. Sorry. Okay. Do we have any questions? I know we had a couple questions in the chat. Let me see here. Let me go ahead and answer that. I've discovered that paying my statement balance in full every month guarantees no interest charge. Is this true for all credit cards or revolving credit accounts? What do you think, Lisa?
Yes, or any kind of credit card or unsecured accounts. So that's unsecured, right there. You're paying a balance or you're paying an amount every month. The difference is an installment or secured is you're gonna have the same amount due every month, the same payment, and there's usually something that you purchased, right, that can be returned if you don't pay the bill. So secured and then unsecured. So yes, if you pay it by the due date, you will not pay interest.
Another one is I did a debt repayment program to fix major credit debt issues. How long will charge off accounts stay on my credit report and negatively impact me?
Okay, so a charge off means that you were late enough that you didn't make a payment until the vendor, the creditor, actually wrote it off on their taxes. They got money off on their tax bill. And so it shows that it's been charged off and it will stay on there for the 7 years that debt stays on. And it, something like that with the old debt, it reduces its impact to your score over time, and so at some point, sometimes it's not even worth paying it anymore, but a charge off, you really can't pay. There are debt repair people that say they can get rid of charge-offs, but I'm not aware of that necessarily being true. I don't know everything. I would not say that either, but a charge-off, it's kind of a done deal. You're better off to just do more positive now than to try to fix it. The damage has already been done to your score.
Okay, we have another question. Is it better to take out a loan to pay down or pay off credit card debt, or does that not matter?
It depends. I'm a big proponent, some credit counselors and financial advisors will say, don't open new debt to take care of existing debt. I think it depends on how much can you get a 0% card, and will you be disciplined now, right? Because you probably, something happened, you know, you got some debt. There's a number of strategies, and that would be something, you know, I would want to talk one-on-one about it to figure out what's best for you.
There's another question. I was getting ready to pay off my credit card debt. Should I not do that?
Well, I think you should always pay off debt. Number one, pay it off. But, you know, I'm reading between the lines. Are you trying to boost the score? So maybe you pay it down to 10%, pay it down to 30%, you know, so using it and paying it every month does help. There is, you know, like if you're maintaining your score, like my husband and I, right, we're pretty much where we want to be. So I actually took out a care credit account for dental work so that I could have a monthly bill that we were paying off, right? It's not costing us any interest. It's just driving that credit engine, because we actually did pay off a car. So it depends on what you're, you know, what you're trying to do and what your credit picture is. I hope I answered that right.
Got some great questions here. Will asking for a lower rate on my credit card affect my score?
It could. They will pull your credit to determine your risk, right? To determine whether or not you are a good enough risk for them to give you a different rate. But it depends. I mean, you can ask them. You call them up, you talk to them, you ask them. If you've been a customer with them for a long time, maybe they're trying to build their portfolio. Maybe there's a deal. Maybe there's some way for them to do a soft pull instead of a hard pull. That could be an option.
I'm seeing what other questions. Someone had asked about the PowerPay. Thank you, Kendra. Kendra put the link in the chat to PowerPay. It's a great website if you guys were looking into paying off some of that debt. Let's see, does Experian Boost actually help? I know that they say they will, count utilities and rent.
Great. I'm so glad you asked that. Experian Boost boosts your Experian score, right? You're going to pay Experian so that your rent or utilities or whatever you're putting in there is going to get reported to your Experian account. And as long as you're making on-time payments, then that positive report is going to go, but it's only going to go to Experian. So what if you go rent an apartment and that landlord uses TransUnion? Or if you go, sometimes even mortgage lenders, you know, they will use their own software, right? And so then it would not help you. It's a real mixed bag.
Someone asked, do you encourage adding a child on your credit cards to build their credit, assuming the parent has good credit?
I did with my daughter.
I've done it as well.
On 2 of my cards, and at least she's getting some track record. She's not credit invisible now. So, you know, we still had to sign when she got her first apartment. So, but it is, you know, helping her build. It's building history, not so much, you know, availability for her.
So I know it's 1:08 and I want to respect everybody's time, but there's some great questions. So feel free to jump off if you have to, but if you want to stick around for some of these questions, because there's some good ones. Someone asked, does marrying someone with a bad credit score affect your good score?
Check me on this, Laurie. So no, it's not going to affect your score, but if the 2 of you are applying for credit together, then, you know, it's when the lender looks at you as a couple, you know, then they're going to see, it could affect you then. For example, when you get a mortgage loan, the lenders do what's called a tri-merge. So if, you know, I was buying a house with my husband, and the creditor, the lender will pull our credit, and they'll see all three of his scores and all three of my scores. And they will base the rate, the interest rate of the mortgage on the lower middle score. So if I have 3 great scores and he's got 3 meh scores, they're still going to use his middle score to determine our interest rate. So that, you know, then you got to say, well, can I buy this house on my own? And, you know, he contributes, or, you know, there are decisions that you have to make.
Right. So
Same with
Deborah
Go ahead.
just had a comment, paying it off, but don't close the account. Yes. Pay them off, but don't close them. How likely are the credit, and I was wondering this myself, Donna, how likely are the credit card companies to actually lower your APR? I've never heard of that.
I don't think that's ever happened to me, that they
Yeah.
lowered the interest rate without
Yeah.
without me asking.
Mhm.
Is that what you mean?
Yeah, I think so.
Yeah, and then in terms of the, you know, the closing accounts, you know, if an account is inactive for a long time, the credit card company may close it themselves. They'll usually send you a letter ahead of time and say, you know, if there's no activity on your account in the next 90 days, we're going to close it. I've got this old Target card that I've had forever, and there's not a Target close to me because I kind of live, you know, in an out of the way place. So I have to like intentionally go buy something from Target or get it online every now and then to keep that credit history, because I've had it a long, long time. So that's part of, you know, part of maintaining that credit behavior is like being aware of what's on your report and that you're using it, that you're keeping it open.
I think you've already answered this question, but I'm going to ask you again. Which score is more important, the Vantage score or the FICO score?
The FICO score is more widely utilized by creditors.
Okay. Someone asked, am I supposed to update my employer's info with these credit bureaus?
Wait, that is such a good question, Susan.
Yeah.
You know, there's a lot of talk about. Now, I actually tried to do some research on this before this class today, and I'm just not sure about the correct answer. But there is the idea that that if you go in and you clean up and remove old addresses, old employers, all that stuff, you ask for that to be removed because it's not current anymore, then actually it can sometimes clear up like collections or old things on your report, because that address is no longer on the report. So I've never specifically been trained that you should remove any old employers, and I'm not sure you can if they're valid.
Yeah, I'm not sure.
But I am told that you can remove old addresses.
Someone asked, should I expect to pay to get my FICO score?
I see that, Christy. No, you should be able to get a FICO score free right from your bank. It's, you know, usually, you know, mine is when I pull up my bill pay, it's there.
Yeah.
You know, so on your bank account webpage, you should be able to find one free of charge. It is a FICO, it's from a bank, so it's a real FICO. If you have a credit card, same thing, you should be able to get a real FICO and see it there. But you can pay for it from one of the credit bureaus. Make sure if you're buying a FICO, buy it from the credit bureaus.
Okay. I think that might be the list of the questions that
There are
you
two
haven't.
in the Q&A panel.
Go ahead.
Oh, there's 2 more in the.
In the Q&A panel.
I'm
No, I think we've.
looking up the question about removing your employer. I'm curious about that.
Yeah, I've already answered those 2.
If
They're
so,
in Q&A.
if it's incorrect employer, remove it.
Yeah. And someone's asking if they can get copies of the slides from today. What do you think, Lisa?
That's okay with me. Patricia, can you make them available to people, or how should we do that?
We can definitely share the PowerPoint if they want to. The recording of this, which has the PowerPoint in there, will also be available. Let me drop that link real quick. Here, so
someone
I
had
dropped
asked,
the link on the chat, so the recording and any relevant resources shared will be uploaded to that webpage.
Okay. Yeah, and I saw the comment about sharing it with your accountability buddy. That is fantastic. That
That's
makes
great.
my
And Christy had mentioned about the myfico.com is another way to get your FICO score.
it is.
Okay, so if there are no more questions, I think this is a good point to wrap it up.